Hi, this is Tim Bigham taking a walk through a recent article up from about a month and a half ago in Stock News that got published on Entrepreneur. The title was Three Reasons Why I Thought AI May Be Artificially Inflated for Microsoft. Indeed, actually proved to be true. I pointed out in that original article valuations certainly were a concern here, right? Implied volatility, another concern, and comparative performance. So instead of writing another article on comparing the comparatives from that article a month and a half ago, I thought a little video might be more informative here. So I pulled off the comparative performance to Microsoft versus the triple Qs. Here is from the article on June 21st. Here where it was to basically start this past week. So noted that Microsoft had been trading at a big premium again to the triple Qs, right? And at the time, Microsoft was the biggest component of the triple Q. You'd expect more of a highly correlated sort of price performance as we had seen over the previous year and a half. But we did see a couple pops in Microsoft that were normally met with a pullback in Microsoft to the triple Q. So looking for that comparative performance gap to close here on Microsoft. Indeed, that was the case. Both Microsoft and triple Qs got hammered, but that nearly 7.5 premium from back, when the article was written, June 21st, had closed virtually flat, only a small premium of a 0.34. So in essence, back to the normal relationship. That big outperformance that we had noted once again had closed sharply. So that favored again a probabilistic put purchase in Microsoft to position to profit for a pullback. Also, valuations, we noted back then that price to sales had gotten extreme, and certainly the case. Here is from June 21st when the article a little over a month ago was written. You can see the price to sales on Microsoft now over 14 times, by far the highest we have seen really over the past 20 years. Briefly was up there in late December of 2021, only to be followed by a severe pullback in the metric and also in the price to sales multiple, because the price of the stock came down, right? So that price to sales came down simply as a function of the math. You can see here, I pulled up a little bit shorter chart here, a 5-year chart, to include that previous spike here in price to sales right from late December, how that pulled back. Once again, Microsoft got over 14 times, but pulled back sharply to close under 12 times price to sales. So again, anytime things get to extreme, probabilities favor things reverting to the mean. Once again happened with Microsoft. And then finally, implied volatility. We absolutely focused on that all the time, implied volatility. And I compared it originally in the article from June 21st, going back to the last time price to sales was over 14 times briefly, right, in December of 2021 to the time in June 21st when it hit over 14 again. Compared the two puts, right, from an implied volatility standpoint. So you can see back then in 2021 December, IV was 32.50, so fairly rich, but now it had dropped to under 23.50 June 21st, even though price to sales stayed the same. So we kind of walked through that comparative between back then to now, comparing the two periods where price to sales was 14 times. So back in December of 2021, right, the $310 put, right, was 6.23% out of the money. The price was $9.50, right, simply the midpoint of the bid ask, and it was about 3% the cost of the underlying stock, simply taking the price of the put divided by the price of Microsoft. Back then it was trading just a little bit over $330, implied volatility at 32.50. Fast forward to June 21st, the previous time that Microsoft hit that 14 times price to sales, right? So we're comparing it from this time to this time here. You can see that a 89 day to expiration. So compare that to 79 previously. So longer days to expiration should make option prices more expensive, right? More time you have, the higher the price of the option, right? The strike price, the 425 strike, compared to the 449.78 closing price of Microsoft, was about 5.5% out of the money. So less out of the money, right, should make the option less expensive, certainly. But you can see here that, again, when we look at the price in a second here, it was, or should make the option more expensive, excuse me. We can see here that the put price was actually less expensive, even though it was closer to the money with more days to expiration, right? The price of the put now is cheaper than it was back then, and it was only 1.89% out of the money previously. 2.87% out of the money. Why? Implied volatility dropped to 23.29. So that big drop in implied volatility nearing the lows we have seen in a very long time is another kind of bearish signal on Microsoft as a stock here. Things getting a little too complacent. Plus, it favors put purchases simply because the price of the put is much more expensive. I'd rather buy a cheaper put that is less out of the money with more days to expiration than the contrary, buying a more expensive put with less days to expiration, less time, right, that is further out of the money. So comparing that, we can see that back on June 21st, the stock was at roughly 450. That SEP 425 put, trading about 8.5 at a 23 and change implied volatility. Fast forward to begin this week, we can see the stock price had gone to 39.15 or had dropped about 55 points. So a big drop in Microsoft, right, of over 12%. Very nice gain if you had shorted the stock, but if you had bought that SEP 425 put back here at roughly 8.5, it closed at about 34.15 on Monday's close, right? So you would have gained 25.5 points, give or take, which would have been more than a 300% gain, right? You're paying $8.50 back here, able to get out well over $34 here. So even though the stock did have a big drop of well over 10%, the option price had a gain of over 300%. Why? Because IV went from 23.29 back then to 28.57 now, which again favors when you see IV jump like that. That shows some nervousness finally, which is usually a somewhat bullish sign for the underlying, right? Fear is starting to pick up, similar to the VIX that we always see spike. Those are usually very good times to consider taking bullish positions in the overall market. And just to kind of compare, we went to the end of this week, right? The stock did rally about 11 points from Monday to Friday's close, right? Those SEP 425 puts, though, dropped more than the stock rallied. Why? Because IV came back into 23.69, started here at 23.29. So things somewhat back to normal, which again, why taking profits when you see everything that you expect to happen is always a good idea. So hopefully provide some insight into how we go about identifying trades, look to put probabilities in our favor. Until next time, as always, here's the good trading. Take care.